How wrong do you think the market is right now, given the data that we got yesterday, and given the fact that you do see resilience with also this disinflation that was apparent?
Well, I think that, look, if we just look at the S&P earnings and, the cost, adjustments that are coming through because of inflationary pressures and, the slowdown in the consumption, it's not hard to predict a 10% decline in S&P earnings. So, that would take us from $220 to $200. And that's pretty mild. Then you take the average multiple for the stock market in a recession, and you say 15 times. That's 3,000. If you want to be generous, you say 16 times. But we were a long way from that sort of a level today, and I think that once we get through this seasonal rally that we're living with, and the relief rally that we got from the last meeting 6 weeks ago, I think that we will renew the downtrend, and we still haven't seen the bottom for stocks.
And I love that, the seasonal rally that we're seeing right now. What would it do to this economy if rates were held at 5.1% for the bulk of next year?
I think it would probably put us into a pretty severe recession. At least I have to say that one thing that I am always driven by historic data. Tom can speak to that. And the one piece of historic data that I can hang my hat on here is the Fed has consistently been wrong in its projections. So I think that
can you sugarcoat that, please, Scott? I mean, can you be less direct? Thank you.
I think that if we actually had the outcome of 5.1%, as the Fed is saying, then we would probably push the economy into a pretty severe recession, because as inflation falls off, that becomes a highly restrictive monetary policy.